If you've seen the news recently or just scrolled through Twitter or TikTok, you know that something out of this world is happening with the stock market, and more specifically, GameStop. The billionaires of Wall Street's hedge funds have gone to war with anonymous Redditors from the subreddit wallstreetbets. Robinhood got involved, lawsuits have been filed, and congressional hearings are being scheduled as we speak. Although my preferred method of investing is real estate, I can't lie, the stock market has really intrigued me this last week. And I mean, people just like us, the little guys, are making hundreds and thousands, tens of thousands of dollars investing in a company that most of us thought was about to follow Blockbuster into obscurity. So in today's video, we're gonna break down what's happening for the most basic level of understanding in the stock market, as well as dig into what's going on behind the scenes, why are lawsuits being filed, and why is Congress and the White House getting involved, and what's gonna happen to this subreddit. Now, I am not a financial advisor. This is not personal financial advice. This is just me breaking down my understanding of what the heck is going on and really asking a couple of questions. Like, why are huge players like Robinhood and Wells Fargo and some little known kind of shadow entities worth billions being accused of illegal market manipulation? And what does a free market even mean at this point? All right, so we're about to get deep into this, and if you guys appreciate this breakdown, don't forget to change the color of that like button, and let's get started. So looking back over the past 5 years, the value of GameStop stock has been steadily declining. In 2017, it was worth around $25 a share, and in August of 2019, it reached its low point of just over $3 per share. This was obviously due to a lot of reasons, namely people not going into brick and mortar stores anymore to buy games. Most people would just buy them online and have them delivered to their house, or they would just download the game directly to their console. And so typical everyday investors weren't looking at GameStop as a good place to invest, because typically when you invest into a company and you want to buy their stocks, you think it's because the company's going to continue to do well and that stock is going to become worth more. For example, if you had a crystal ball and could have predicted Tesla's recent success, you would have bought their shares in March of 2020 before the world shut down for just $70 a share. And today, that share would be worth about $830. So you can see why many people weren't very interested in GameStop over the last couple of years. But there's another way that's not too typical to invest in stocks, especially if you think that the company is actually going to fail. This is called shorting a stock, and it's exactly what billion-dollar hedge funds on Wall Street did with GameStop. Here's a very basic explanation of how shorting works and why it's one of the riskiest ways possible to invest in the stock market, shown by the billions of dollars that hedge funds have lost in the last few weeks. Last month, in December of 2020, GameStop was trading for about $15 a share. Now, if a hedge fund was to see that and predicted that share price would fall even lower and that GameStop would continue to fail as a company, they would do something called short the stock. This means that they're betting on that stock to fail. And so they would borrow that stock from a brokerage and sell it immediately for $15. Then they'd wait. They'd hold on to that $15 they got from immediately selling the stock, and they would pay interest to the brokerage for the loan. And while they're waiting, in the best case scenario, the stock price would fall. Let's say it fell to $5. Well, then they would buy that stock for $5, return the stock to the brokerage that they loaned it from, and keep their $10 of profit in the middle. But what if the stock price doesn't fall? In this case, instead of dropping to $5, let's imagine that the stock price rises to $25. Well, in this case, the hedge fund has $15, but they still have to go out and get that $10 from somewhere, buy back the stock, then give that stock back to the brokerage that they borrowed it from so that they can repay their loan. And the higher that price goes, from $25 to $50 to $75, they are still obligated to buy back that stock to pay off their loan. So technically, the hedge funds could have infinite losses depending on how high that stock price rises. And obviously in this example, we're talking about $5 here, $10 there. But as of January 27th, hedge funds who shorted GameStop stock have lost more than $5 billion. Yes, that's a billion with a B. The largest short seller of GameStop is a hedge fund called Melvin Capital, and on Tuesday, they borrowed almost $3 billion from other hedge funds so that they could scramble and buy up the skyrocketing shares of GameStop, pay off their loans, and do what's called closing out their position. So the question is, why did GameStop's share price skyrocket so much in such a short amount of time? And the short answer is Reddit. While there were some indications that GameStop was gonna make a bit of a comeback, given the fact that new ownership invested in the company and they had a history of taking brick and mortar stores successfully into online stores, as well as due to the illness and the release of the PlayStation 5, more people were starting to use GameStop's online services. But all of this was small change compared to what the Redditors did. While some Redditors may have truly believed that GameStop was an undervalued company and thought that GameStop was going to grow and therefore bought in, the real fuel on the fire of all of this is what the hedge funds were doing. As of last Friday, 140% of GameStop shares were in the short position. This means that all of these hedge funds were trading more shares than even existed, all on the anticipation and making the bet that GameStop's share price was continue to drop, they would be able to buy back in, satisfy their loans, and make millions, billions of dollars of profit. But being this dependent on the stock price dropping left the hedge funds vulnerable, and that's when the subreddit wallstreetbets swooped in. A ton of users from the subreddit started buying shares of GameStop, which at the time was only about $20 as of Monday, January 11th. But at its peak, just 16 days later on January 27th, the stock price had risen to almost $350 a share. This meant that as that stock price grew higher and higher, not only were the Redditors making paper gains, meaning they weren't actually seeing that money in their bank account unless they chose to sell the stock, but here's the thing, they weren't selling. And because they decided not to sell and just to continue to buy, it kept driving the stock price higher and higher, which of course just made it more and more expensive for those hedge funds to buy back in so they could repay their loan. So basically, you've got Redditors on one side driving the stock price higher and higher because they know that no matter how high it goes, eventually the hedge funds are going to have to buy it back so that they can repay the loans for all the stock that they shorted. And on the other side, you've got billionaires like this guy who are complaining that these retail investors don't know what they're doing and are ruining our markets.
The reason the market is doing what it's doing is people are sitting at home getting the checks from the government, okay? And this fair share is a concept. It's just a way of attacking wealthy people, and I think it's inappropriate. We all got to work together and pull together.
He forgot to mention that he's a literal billionaire who had to pay SEC fines and agree to monitoring because he's guilty of insider trading, as well as the fact that he cried on live TV last year because Elizabeth Warren said that she would raise his taxes. Yes, I said billionaire with a B. So it seemed like the little guys were finally beating Wall Street at their own game. One user said that he used his profits to pay for his mom's medical bills. Another one said that he was refusing to sell until the stock price reached over $1,000. And one of the biggest users on wallstreetbets, whose name I have to blur out for monetization reasons, he bought $50,000 of shares in GameStop back in August of 2019. He said he felt like the stock was undervalued and would go up in price. He's been posting updates every day for the last couple of days. And as of the end of the day on January 28th, that $50,000 is now worth over $33 million. But we probably should have known that the free market wasn't going to let the little guys keep winning. On Wednesday night, Robinhood sent out an email encouraging their users to continue to make smart decisions and to not make risky investments that they weren't educated on. And the next morning, Thursday, January 28th, they stopped allowing users on their platform to purchase a selection of stocks, including GameStop. That's right. Robinhood made it impossible for individual investors to get in on the rising value of GameStop's shares, whereas Wall Street billionaires were able to continue trying to mitigate their losses while Robinhood basically put everyone else in timeout. As one person on Twitter said, regular people were making too much money. Huge banks like Wells Fargo banned their advisors from recommending stocks like GameStop or other ones that the subredditors were boosting up like AMC or Bed Bath & Beyond. The stock trading platform Webull temporarily blocked their users from buying some of these stocks as well. Although after seeing the backlash that Robinhood was getting in the form of thousands of negative reviews, articles, tweets, and even calls for congressional hearings, Webull kind of walked that back pretty quickly and started to allow people to buy whatever stocks that they wanted. Even Robinhood has started to walk back their decision and has said that they're going to allow limited purchases starting January 29th, aka tomorrow. But why is this even happening? The hedge funds are complaining that Redditors are manipulating the markets, whereas Redditors are saying that they used publicly available information to see the huge bets that Wall Street was taking, and they took an opposite bet and won. And why is Robinhood stepping in to stop these individual retail investors from purchasing to help out the hedge funds? So here's where it gets even deeper. In the wake of the Occupy Wall Street movement, Robinhood has often emphasized that they're here to democratize finance for all. And one of the big benefits of their platform is that they offer commission-free trading. So they're not charging you an extra commission on every stock that you decide to buy or sell. But obviously, they still have to make money, and they do this by selling your trades to market makers. These are large funds that basically pretend to be the market for Robinhood. So on a really basic level, when you buy a stock through Robinhood, they sell that trade to a market maker like Citadel Services, who's their largest buyer. And Citadel Services pays Robinhood a couple of pennies per trade, but a few pennies per order obviously add up. And a recent SEC filing showed that Citadel Services and other market makers paid Robinhood $100 million in just the first quarter of 2020. So why does Citadel Services pay Robinhood so much to sell them your trades? Well, when Robinhood passes on the information about your trade to Citadel, Citadel uses their high-frequency trading algorithms to process that information a split second faster than the rest of the market can when your trade actually completes. This means that when you want to buy a stock, their algorithm in a split second will analyze the market and decide if they themselves should fulfill that order and sell it to you, or if they should pass it off to the actual market for someone else to sell it to you. The companies with the fastest algorithm to make this decision are the ones that profit the most, but they don't always give you the best deal. In 2017, Citadel Services was fined $22 million by the SEC for misleading clients about how they were pricing these trades. Robinhood was also fined $1.25 million in 2019 for failing to make sure that orders purchased by companies like Citadel were actually in the best interest of the original trader. And remember when I said earlier that Melvin Capital was the company with the most to lose because they had shorted so many shares of GameStop? Well, guess who bailed them out with the $3 billion so that they could buy back shares and exit that position? Citadel Services. So Melvin Capital gets a multiple billion-dollar bailout from Citadel Services, which is also the same company that pays Robinhood hundreds of million dollars a year. And some people have even said that Citadel took out more short position on stocks before pressuring Robinhood to shut down the purchase of GameStop and other securities, which in my understanding would definitely be very illegal. Now, Citadel Services has said that they in no way pressured Robinhood to make this move, and Robinhood has said that they weren't pressured and that they were doing this in the best interest of protecting their customers. But there's obviously a very twisted web between these billion-dollar companies. And it's not just Robinhood. Google deleted over 100,000 negative reviews of Robinhood today, and before the illness, senators got a private briefing about what was coming and the shutdowns and the deaths, and bought stock in companies that produce body bags and didn't tell anybody what was about to happen and received no consequences. In my opinion, it seems like there's two different sets of rules here for the rich and the not rich. Investing is risky, and that's why it's called investing. Like, you can make a lot or you can lose a lot. Wall Street took some very risky billion-dollar bets, and now Robinhood and other corporations are helping to bail them out. If you and I make a risky investment in stocks, in real estate, in Bitcoin, and we lose our money, no one's coming to bail us out. Even for millions of people who made smart investments in their mortgages or on student loans are fighting tooth and nail to get help with those loans or get to those loans forgiven. But to be honest, I'm not holding my breath on that. Yet, in just a few days, Robinhood and other multi-million-dollar corporations seem to have stepped in to help the hedge funds on Wall Street. The CEO of Robinhood just spoke a little while ago before I recorded this video. He said that the stocks were going viral on social media and he had to protect his customers. He also emphasized that there were thousands of other stocks available to trade and that people could still sell GameStop, they just couldn't buy it. And again, I'm not a financial professional, and obviously the CEO of Robinhood knows a lot more about this than I do, but in my understanding, it seems pretty clear that not allowing individual investors to buy the stock, only allowing them to sell, only benefits the hedge funds and the billionaires. It caused the value of GameStop stock to drop today, and it allowed the hedge funds to buy back in and to settle their debts without the price continuing to skyrocket. And since I don't feel personally educated enough in the stock market and I'm not willing to make that investment and risk losing that money, I'm not gonna start buying and selling stocks like GameStop. But Wall Street hedge funds chose to make those investments and take those risks. And the Redditors from GameStop are choosing to take their risks and make their investments. They're just winning right now. And right now, they're holding the line and refusing to sell, trying to continue to push that price higher and basically bankrupt the billionaire hedge funds. And I, for one, give them some applause. If it's truly a free market, let the chips fall where they may. Maybe the pressure from different users and Congress on Robinhood, which is, I think, causing them to open back up tomorrow morning or Friday, January 29th, will cause the price of the stock to continue to go up. Maybe the SEC will crack down on Robinhood and Citadel and companies like that, and maybe the subreddit wallstreetbets will get banned. I, for one, hope that the Redditors don't sell and that Wall Street has to pay the consequences of this risky bet. When things get tough, the rest of us obviously don't get bailed out. And so why should Wall Street be any different?